I've created what I believe to be the greatest all-in-one Excel template for personal finance. One system that brings together your budget, your net worth, and even a full long-term projection. And this is how it came to life. My tutorial on how to create the ultimate personal budget in Excel became one of the most watched YouTube videos for managing your personal finances in a spreadsheet. Thousands of people built their own version or grabbed the ready-to-use template from our website, and the feedback was incredible. But anyone who tracks their finances knows that budgeting is just the first step. The real motivation kicks in when you start seeing progress in your net worth, when your assets grow, and your debt starts to shrink. That's why I introduced the net worth tracker as the perfect complement to turn your budgeting discipline into real visible progress toward your long-term goals. Side by side, these two templates make managing your personal finances in Excel simple, structured, and motivating. And since they're fully editable in Excel, they are the perfect base for you to build any extra feature or extension on top that you want. You can customize them completely to your own needs. But over time, many of you reached out offering to pay us extra for implementing advanced features and customizations on top of your base templates. Instead of creating individual one-off versions, I took the most commonly requested upgrades and built them into dedicated Pro versions to make them accessible to everyone at just a small premium. With these Pro templates, you get the same simplicity of the base templates, but with the additional extensions already pre-built for you, saving you the time of creating them yourself or the cost of hiring someone to do it. And to fulfill the most frequent request, I also merged both these Pro templates into one seamless file, the all-in-one Personal Finance Suite. That means no duplicate transaction tables, no switching back and forth, just one streamlined system where everything connects automatically. All of these extended templates, including the all-in-one Personal Finance Suite, are now available on excelfind.com. Link for that is in the description. Let's take a look at the new extensions we added to the Pro version of the personal budget. The overall logic and simplicity of the template structure is still the same as in the base version, with two input worksheets, one to plan the budget and one to track all transactions, and the interactive dashboard as the main output worksheet where all the entered data is automatically brought together, analyzed, and visualized. What's new though compared to the base version is that we added the differentiation between budget categories and budget positions. So you can now decide if you want to have your budget broken down super detailed by each budget position in this budget breakdown section and these allocation charts, or more high-level by budget category, which gives you a much more condensed view. This is now possible as the budget planning worksheet no longer has just one column like in the base version to define all the individual budget positions, but now we have a second column right next to that to assign matching high-level categories that can be managed in the categories worksheet. We also added debt as a new and fourth budget type. While in the base version of the template, the simple logic was you have your income, you deduct your expenses, and everything left after that is put towards savings, the Pro version now goes one step further and lets you differentiate between savings and repaying debt. This differentiation is present throughout all sections in this dashboard, and since both actions, saving and repaying debt, have a similarly positive effect on your net worth, we also put the combined savings plus debt rate into focus up there instead of just the savings rate. Another heavily requested extension was the addition of accounts. In the Pro version, you can now define all your asset and liability accounts with their respective start value, assign matching categories which can be managed in the categories worksheet, and then, when you track your transactions, you have this account column where you can assign any of the defined accounts. This allowed us to add this completely new account insight section in the dashboard. Here, you can select the view to be either high-level so that the accounts are grouped into short-term assets, short-term liabilities, long-term assets, and long-term liabilities, or when you switch to one of those focus views, that group is uncollapsed while the other groups and thus the overall context is still maintained. Or you select one of the corresponding isolated views to just display the accounts in that group. Whatever view you select, you will see the cash flow balance, the number of transactions, the transaction volume, and the net flow by account or group, as long as you have summary selected in this KPIs dropdown. but you can also switch that to movements, and that will give you this powerful breakdown of the cash flows by account and budget type. So you can instantly see which accounts your income, expenses, savings, debt, and transfer cash flows went through, and even how money moved between accounts, like an ATM cash withdrawal or savings and debt transactions that move money from the bank account to other asset and liability accounts. And to top this all off, the Pro version has a number of new powerful dashboard insights on top of what is already available in the base version. Just like in the base version, you can select the display period to be an individual month, or switch to a total year view, which then will compare your track data against a full year budget plan. But on top of that, I've now also added a new year-to-date view that compares your track data only against what you have budgeted up until the current month, giving you an even clearer picture of where you stand and making it fairer for categories that fluctuate throughout the year. To complement that, I have also added this remaining versus budget plan tile that instantly shows you which budget types still have some remaining budget and which already have reached or exceeded the planned amount. That's especially helpful in both the year-to-date and the monthly view. This tracked versus budget chart not only got a huge design upgrade, but I also added a function to let you understand your relative performance in each budget type in one look, which is especially helpful if one budget type has relatively small numbers. You can now just check this normalized checkbox and the chart will switch to this relative view, showing you exactly how the percentages of all 4 budget types compare. And eventually, since the savings plus debt rate is one of the most important numbers you want to optimize for in order to grow your net worth effectively, the Pro version gives you all the insights for that KPI in this new rates versus income section, visualizing it over time and compared against your budget plan. You can also switch the visualized rate to only the debt or savings rate or the expenses rate, which essentially is the counterpart to your savings plus debt rate. And that way you get an instant evaluation of your budget performance and your overall trajectory. With all these powerful Pro extensions layered on top of the base template, budgeting becomes faster, deeper, and more intuitive than ever. Now let's take a look at the new extensions we added to the Pro version of the Net Worth Tracker. Here, the overall logic and simplicity of the base template structure is also maintained, with 2 input worksheets, one to define all asset and liability positions and track their values, and one to track the contribution transactions. And then as the main output worksheet, we have the interactive dashboard where all the entered data is automatically brought together. While you will find part of the Pro extensions we added in the dashboard worksheet, the biggest addition in the Pro version is a completely new and super powerful worksheet to project your net worth into the future. So let's dive in and take a closer look. As a major extension in the dashboard, you will find a number of new net worth growth metrics, starting with this percentage number up here that tells you how much of the net worth growth that you see over here comes from capital work, so your money working for you instead of you for the money. And to complement that, you see your assets' internal rate of return, short IRR, which is the true annual return adjusted for timing of all cash flows, and arguably one of the most meaningful performance metrics for comparing assets. Right next to that, you see the effective cost rate, short ECR, which is the respective pendant for the liabilities in the form of the true annual costs or interest. When jumping down to the newly organized detailed analysis section and selecting assets as the type, you see how the IRR metric is now also available for each individual asset position. And the same for the liabilities with the ECR metric. Of course, you can now also sort your positions by their annualized performance, telling you exactly which are the most profitable positions in the selected time span. And to add in even more clarity, you can now also filter down the positions by horizon to either short-term positions or long-term positions. While the net worth dashboard perfectly breaks down the past up until the present, the Pro version now offers a way to also model the future with this new net worth projection worksheet. It automatically starts off exactly at your latest point in time with the respective net worth and then projects its development up until retirement and beyond. Those numbers are modeled either nominally or, if you prefer, adjusted by inflation. The model is driven by a number of assumptions that you can freely modify and play around with, starting with the fundamentals down here. Based on what you enter for the initial annual net income and annual expenses, as well as the income growth rate and your personal inflation rate, you see how the cash flow projection over here adjusts accordingly, perfectly modeling how your base income and base expenses would develop over the years, leading to either a positive net cash flow that would be used to build up assets and pay off liabilities, or a negative cash flow, meaning you would need to liquidate some of your assets to finance the gap. To model the future performance of your assets and liabilities, you can adjust your assumed future asset gains and liability costs, noticeably impacting where your net worth is headed. Over here, you can then change the assumed retirement start year to, for example, figure out the impact of retiring a few years earlier, potentially with a stable retirement income at a certain growth rate. So far, this cash flow projection only reflects your base cash flows, which makes the whole projection look pretty smooth and linear. But real life isn't that simple. That's why I decided to make this model way more realistic by adding the option to define extra cash flows down here. Here you can enter all the extra cash flows that are not covered in the assumption so far, with a short description, the type, the annual amount, the start and last year, and a growth rate. However, these extra cash flows won't be included into the model until you set an X in this include column, giving you full flexibility to include or exclude certain scenarios. Once these extra cash flows get included, you see how the cash flow projection begins to draw a much more realistic picture, which of course then visibly also impacts the net worth projection. It might lead to a point where the projected net worth at the end of the projection turns negative, giving you the opportunity to play around with some of the assumptions to figure out under which conditions it would play out better, like retiring a few years later, or aiming for higher annual asset gains, or focus less on the side hustle and more on accelerating your career. The options to model out your future are endless. With these powerful Pro extensions layered on top of the base template, managing and steering your net worth development becomes clearer, more controlled, and far more actionable. Now that you've seen how powerful these two Pro templates are individually, let's deep dive into the all-in-one personal finance suite, which is both Pro templates combined and fully integrated with each other in one template file. As you see in the personal finance suite, you have the Pro budget dashboard, the Pro net worth dashboard, and the new net worth projection all side by side. While both Pro templates each had two main input worksheets, so 4 if you add them up, I was able to reduce that to 3 when combining them. I took the budget input sheet from the Personal Budget Pro, the Net Worth input sheet from the Net Worth Tracker Pro, and then I merged the transaction worksheets of both Pro templates into a combined one that will power both dashboards at once, saving the user a lot of time and effort. Now let me walk you through the entire template from scratch and show you how easy it is to enter your own data. At the beginning, we only have the starting year and starting month defined in the settings sheet, and the high-level categories for the budget and the net worth defined in the categories sheet. The 3 main input sheets, budget, net worth, and transactions, are fully empty, and for that reason there's not much to see in the budget dashboard and the net worth dashboard so far. Accordingly, the net worth projection starts off at 0 and has only some placeholder values entered for the assumptions. Let's start in the budget worksheet by defining the budget positions in these 4 sections and plan the according budget amounts for the first year. To add a new position in any of these sections, you can simply unhide these prepared empty rows, enter your positions, and then assign matching categories. Every additional dollar in income that you plan for a month will increase the amount to be allocated in that same month. Just like in the income section, you can add as many custom expense positions as you need in these prepared empty rows. Since you now have the option to assign high-level categories, you are free to define the single positions as granular as you want. The expenses should cover both your needs, like for example housing, groceries, and transportation, but also your wants like fun, entertainment, and travel. Every dollar planned for an expense position will decrease the amount left to be allocated, so that after you have planned all your expenses, you know exactly how much will be left for your savings and repayment of debt. Before we define the budget positions for savings and debt, it makes sense to take a look at our assets and liabilities so that we know where it makes sense to allocate the remaining money. For that, let's move over to the net worth sheet and quickly define all our asset positions such as bank account, cash on hand, emergency fund in a high-yield savings account, another savings account, brokerage accounts, 401k, Roth IRA, maybe a watch collection, and a car. And then we assign according categories to all these positions. It's interesting to know that with assigning categories, we automatically assign certain characteristics, which are defined in the categories worksheet, to each account. For the assets, these characteristics are the horizon, either short or long term, if it's cash or not, and if transactions associated with that account will be considered or ignored in the budgeting process. To finalize the setup, we need to enter the initial base value for each position, so the value that position has at the end of the month right before the start month, in this case the last day of December 25. Then we also add the liability positions such as outstanding credit card debt, so the balance that is carrying interest, student or personal loans, and also loans that were used to finance assets, like for example a car loan. For all these, we add a matching category and then enter the initial outstanding balance at the end of December 25. With all this entered, we now see the initial net worth up here and can start thinking about to which positions we need or want to contribute the money to that we have available after expenses each month. For example, we need to do monthly payments for the undergraduate loan and the car loan. For the family loan, we assume that we have agreed to pay the money back in full in a few years, so it's not relevant now. And we want to pay off the outstanding credit card debt as fast as possible. For the assets, the 401k is pre-tax, so it will be not part of the post-tax budget, but we do want to make a regular contribution to the Roth IRA and grow the emergency fund to a saver 10k. And after that, we simply want to invest and save toward a down payment. With all this in mind, we can then define the respective budget positions in the savings section, and the debt section. And then start allocating this remaining amount aligned with the priorities we just identified. We start with the regular payments, so we need to do the regular payments to the undergraduate loan and the car loan, while no monthly payment is necessary for the family loan. And we also want to do regular contributions to the Roth IRA. And then with the remaining amount, we work on our short-term and long-term priorities. The highest priority should be to pay off the outstanding credit card debt, as this costs us huge amounts of interest, way more than any asset can reliably generate in return. So until all credit card debt is paid off, we plan to allocate the whole remaining amount to that budget position and set everything else to zero. After that, the overall amount left to be allocated is exactly zero, which means you now have a plan for every dollar of disposable income and your budget plan for that month is completed. But in real life, not every month is the same, and for many categories, planning the exact same amount each month is not realistic. For that reason, this budget worksheet allows you to create a realistic multi-period budget plan in one place in basically no time. Let me show you how you can expand this budget plan to the whole year. In case all income positions will stay the same in each month, planning the remaining months is done in a second using the autocomplete handle. But if you have a bit more variety in your monthly income, so for example you know there will be a level shift for your salary through a promotion, then you have an income category that you expect to stay on the same level each month, and a third income source that you know will be different every single month. All of this can be accurately portrayed in your budget plan. For the expenses, you can plan regular expenses ahead just as easy. In case you have an expense position that will be paid only once a year or once a quarter, like insurances for example, you don't have to break it down into 12 equal monthly amounts, but you can budget the actual expense whenever it's expected to be paid. Obviously, there are regular monthly positions like shopping that are a bit more volatile than other regular positions like for example rent. Yet, setting a fixed monthly budget for these positions will give you a good benchmark in case you cannot exactly predict the distributions over the year. And finally, you can also have fully irregular expenses like gifts or vacation for which you only plan specific amounts in certain months of the year. Every expected variation of expenses can be accurately represented in the budget plan. And now up here, you see exactly how much is left each month to be allocated in the savings and debt sections. Here, we will continue following the priorities we identified earlier when reviewing the asset and liability positions. So we start with the regular payments we need to make, like the undergraduate loan and the car loan, and then move on to the contributions we want to make, such as the regular payments into the Roth IRA. After that, we focus on paying off the credit card debt first, so we fully allocate the entire remaining amount each month to that position until we have covered the full outstanding balance plus interest, and then we can set the following months to 0. After paying off the credit card, the second short-term priority was growing the emergency fund from 7.5k to 10k, which we can start in April and plan to complete in June. The remaining amounts can then be distributed among our long-term goals, like growing our stock portfolio or saving for a down payment. What's crucial in the end is that for each month you have a plan for every available dollar from your income streams, so that the amount left to be allocated is exactly 0 and the green check mark at the top is visible. With that, the budget plan for this first year is complete. When we jump to the budget dashboard, all the defined positions and planned budget amounts are instantly visible. We can change the level of detail to categories to get a more condensed view of the budget plan, or back to positions to keep it super detailed. The tracked versus budget chart already displays the planned amounts over the year in these light shades. And the rates versus income chart shows us the expected expenses rate of our budget plan over the year. Just like the savings rate, the debt rate, and the savings plus debt rate. Moreover, using the drop-down at the top, you can easily switch from this total year view to the different monthly views of your budget plan. Now that the budget plan is set up, we can move to the transaction sheet and start a monthly tracking routine by entering all relevant transactions throughout the month. To enter a transaction, simply enter a date, the amount, which should be positive for incoming and negative for outgoing money flows, and some details. These 3 pieces of information are the core of every transaction and exactly what you would find on a regular account statement. The other 3 columns are then used to add context. In the account column, you can assign any of your defined asset or liability positions. In this case, the paycheck goes straight to the bank account. And then we select the budget type as income and based on which type we have selected, all the previously defined budget positions of that type become selectable in that budget position dropdown. While the first transaction had a positive amount as it was income hitting the bank account, expenses are supposed to have a negative amount as they are leaving the respective account. And with expenses now selected as the budget type, the budget position dropdown will automatically adjust its list of values to show all previously defined expenses positions. It's important to mention that the selected account and the selected budget position do not depend on each other, so you can match any account with any budget position. Also, as you might have noticed, positive amounts like for the income at the top are automatically colored in green, while negative amounts are colored in red. When we add the budget dashboard in split view, you can clearly see how every new transaction instantly updates the tracked amount for the corresponding position in this dashboard's budget breakdown. The positions in the breakdown are automatically sorted by tracked amount first and by budgeted amount second. This way, you always know exactly what percentage of each budget you've already used and how much is still remaining for every budget position and budget type. For tracking your transactions, it's important to mention that income and expenses are typically one-sided transactions, as money either comes from an external source or goes to an external target. Savings, debt, and other transfer transactions, on the other hand, require you to track both sides of the transaction, since money moves between two of your accounts. So for this Roth IRA contribution, we not only need to track the $400 moving out of the bank account, but also the $400 received in the Roth IRA account. By tracking both sides of the transaction, we make sure that in the net worth dashboard we can correctly differentiate between the contributions made to the Roth IRA and the actual gains. And don't worry, from a budgeting perspective, only one side of the transaction counts toward the budget position, so the second opposing entry won't cancel it out. Just like that, all the transactions for the month gonna be tracked following that one-sided and two-sided transaction logic. Also, in case you have money flowing into one of your accounts completely outside of the budgeting logic, like for example a pre-tax 401k contribution, you can still track it without assigning any budget type or budget position. This makes sure that the contributions and gains for that asset position are still calculated correctly in the net worth dashboard. For anyone who gets paid late in the month and wants to treat that income as part of the next month's budget, you can enable the Shift Late Income option in the settings sheet. This lets you define a cutoff day, for example the 20th, so that any income received on or after that day in the month is automatically counted toward the next month. In this example, the paycheck received on the 27th of December is now assigned to January instead of December, and in the date column, this shift is highlighted with an arrow and calendar icon. Once the end of the month is reached, your monthly tracking routine is then completed by jumping to the net worth tracking sheet and simply entering all current values of your asset and liability positions. These values can be obtained by checking account statements, market values, or making estimates based on past valuations. Once this end-of-month snapshot in here is completed, an updated net worth value is displayed at the top. For all following months, you simply need to follow the same tracking routine. During the month, track all the relevant transactions in the transactions table. And once the end of a month is reached, capture the values for each individual position in the net worth sheet. By following this simple tracking routine, both the budget dashboard and the net worth dashboard automatically populate with all the relevant data from your tracked months. Let me walk you through the personal budget dashboard in detail, and for that we will fast forward into the middle of the next month. With the current month as the selected period, we can see how much of that month has already passed, which makes it easier to evaluate the percentage of your budgeted amount that you have tracked so far for each budget position. Or if we change the level of detail, for each budget category. In addition, the period tracking balance shows you exactly how much of your tracked disposable income is still left to be allocated in that month. And down here, that balance value is then perfectly broken down into the remaining budget amounts and the amounts that have exceeded the budget. This new remaining versus budget plan KPI tile gives you an instant snapshot of how your budget is doing, without the need to dig deeper into the detailed breakdown. You immediately see what's still remaining, what's on track, and where you might be exceeding or overshooting. Then, in the tracked versus budget chart, your tracked budget performance for the income, expenses, savings, and debt is visualized and highlighted. You can switch between a normalized view to compare the relative progress and the absolute view to compare the scale of the different budget types. For those tracked amounts, you then have a breakdown of the exact allocation for the income, expenses, savings, and debt in these beautiful circular charts. Just like for the budget breakdown on the left, the level of detail here depends on this drop-down at the top and can either be more detailed by position or more high-level by category. Up here, you'll find the savings plus debt rate, which is a crucial number as it depicts how much of your disposable income is used to improve your financial situation, or in other words, to increase your net worth. 21% here means that so far in this month, 21% of the tracked income has been allocated to either savings or debt, which is still below the 40% that we have implicitly set as target value through our budget plan. To understand this number in a time-based context, we can then jump to the new rates versus income section and take a look at this visualization of the savings plus debt rate over time. We can switch the displayed rate to only the debt rate, the savings rate, or the expenses rate to even further evaluate how we perform against the budget plan. Eventually, the Account Insight section allows us to understand the cash flows in our accounts, either on a high level, grouped by account type and horizon, or with one of these groups uncollapsed in the respective focus view for the short-term assets, the short-term liabilities, the long-term assets, and long-term liabilities. For each focus view, there's a corresponding isolated view displaying only the accounts of that group without any additional context. And then switching back to the corresponding focus view simply adds back the other groups in there again. For each account and group, this section displays the cash flow balance, the number of transactions, the transaction volume, and the net flow in the selected period. But only if we have summary selected in this KPIs dropdown. When we change that to movements, the columns display the full budget context in one condensed view, showing us the net cash flows associated with income, expenses, savings, debt, and transfers. For the bank account, for example, we can instantly see that $5,250 of income went into the bank account. Then $1,510 went out for expenses. Then $1,100 went out for savings and debt, and we can instantly see where that money went to. The same goes for the $500 withdrawn at an ATM, so they left the bank account and were added to the cash position. So to sum it up, all these one-sided and two-sided cash flows become instantly visible in this matrix view. For the whole dashboard, we can change the display period to any specific month. Or switch to the total year view, which then takes into account all the tracked amounts in the year so far and compares it against the total year budget plan, allowing you to assess how much of the year has passed versus how much of the budgeted amount for the total year has already been tracked in each category. Alternatively, we can switch to the year-to-date view, which also takes into account all the tracked amounts for the year so far, but compares that not against the full year budget plan, but only against what you had planned up to the current month. This gives you a better idea how good you are on track against your budget plan up until that point. Overall, this budget dashboard gives you all the tools to monitor, evaluate, and steer your monthly cash flows, keeping you in full control and helping you to channel more money into savings and debt. And the impact of that will ultimately be reflected in your net worth dashboard. Before we dive deeper into this dashboard, let's fast forward a bit and watch how the dashboard evolves with each new month of data added in the input sheets. Whenever there's a noteworthy event, like for example when you get promoted, you can note that down at the bottom of the net worth sheet. And it will automatically be displayed for that month in the net worth development chart. At some point, you might want to define, track, and visualize some goals for your current net worth development. You can do that in the Goal Analysis section. Simply define a custom name for your goal and the net worth target you want to reach. You will instantly see your progress toward that goal, and by marking it in the Show column, it becomes visible in the net worth development chart above. You can also set a target date for your goal, giving you a clear timeline to aim for. Overall, up to 4 goals can be defined to reflect the different net worth levels that you want to reach over time. Since adding a target date is fully optional, it doesn't matter if you already have an exact timeline in mind. You can always just define and display any of these goals in the chart above for motivation and perspective. Below the Goal section is a custom KPI section, where you can run your own calculations using dynamic metrics like net worth, total assets, and total liabilities for the selected focus month. This can be as simple as estimating how long your net worth would last at a given expense level, but you also have the flexibility to create more advanced and sophisticated KPIs for yourself if you need them. As the dashboard evolves over time, your financial journey is beautifully captured and monitored from multiple angles. With 2 years of data in here now, let me walk you through the different parts of the dashboard. With the latest tracked month selected as the focus month, you can see your current net worth and how it has developed over the selected time span. This net worth development is then beautifully visualized in this chart down here with all the special events highlighted. In the chart, the net worth development is compared against all the contributions you made, clearly showing how much you gained or lost along the way. Both lines start from the net worth level right before the selected start month, so no matter which start month you select, the comparison always aligns with the selected time span. It's also compared against your custom net worth goals, defined down here. And once a goal is reached, you can easily display the next one to stay on track and maintain your motivation. To better understand how your net worth is composed of assets versus liabilities over time, the net worth development chart is complemented by the asset versus liability development chart. It illustrates how the levels and the span between the assets and the liabilities, along with their respective contributions, develop over time. This helps you better understand the changes in your net worth and the leverage in your portfolio. With every asset purchase that is primarily financed through additional debt, like the investment property purchase over here, the span between these lines and the implied leverage increases. The difference between your total asset value and the asset contributions represents the gain you've made on your assets, while the difference between the total liability value and your liability contributions represents your cost of debt. For the selected focus month, you can always see the total asset and liability values up here, along with the respective net leverage ratio right next to them. The net leverage ratio shows which portion of your non-cash assets is financed through debt. It's a simple risk metric that first deducts cash that could be used to instantly pay off debt from both the asset and liability side, and then the resulting net debt is simply divided by the non-cash asset value. To better understand the composition of the current total asset value, it is broken down into the main categories over here in this asset allocation chart. This gives you a clear insight into how your assets are distributed and whether there are any noticeable concentrations. In a similar way, the breakdown of the total liability value into its main categories is displayed over here. These allocations may change significantly over time as positions in different categories may be added and removed, or grow and shrink in your overall portfolio. Up here, you can get a better understanding on how much of your net worth growth comes from money working for you instead of you working for the money. In the selected time span, 10.4% of the net worth growth came from capital work, which basically is asset gains minus liability costs. The other 89.6% of that growth came from contributions to asset and liability positions, so money you have worked for. With 10%, you would still be early in your financial journey, but as this number grows, your money begins doing the heavy lifting, which is a key step toward financial independence. To better understand the driving forces behind this, we've got the internal rate of return, short IRR, as profitability metric for your assets, and the effective cost rate, short ECR, as the cost metric for your liabilities right next to it. When the IRR of all your assets is much higher than the ECR of all your liabilities, like we see here, it's a strong indicator of a healthy productive leverage, because your asset returns are beating your borrowing costs. Eventually, to get an even deeper understanding of your asset and liability composition and performance, you can head to the detailed analysis section and choose whether to deep dive into either your assets or liabilities. Over here, you have this tabular breakdown that can either be more condensed on a category level or more detailed on a position level. This tabular breakdown shows the current value for the selected focus month and how it is composed of the starting value from before the selected time span, along with the contributions and gains made during the time span. While the gain column only shows you the absolute return of an asset, the IRR is a relative measure that adds context by accounting for when you've invested your money and how long it was actually at work. You can always decide by which column to sort the breakdown so that you not only see which are your largest positions, but also understand where you put the most money into, where the majority of your absolute gains and losses are coming from, and which assets deliver the strongest annual performance. This summary section over here then breaks down the composition of the total current value into start value, contributions, and gain, perfectly outlining the absolute numbers and their relative impact. Instead of always looking at all your assets, you can also filter the section to only show your short-term assets, which you typically expect to yield lower returns, or only your long-term assets, which are usually responsible for the majority of your returns over time. When switching to liabilities, the logic is exactly the same, except the gain component is now replaced by the respective equivalent cost, just like the IRR is replaced by the ECR. So, to sum it up, this net worth dashboard gives you a full 360-degree view of your financial journey so far, covering everything from the past up to the present with your current net worth. And this is exactly the point the net worth projection will automatically start from, extending your net worth development into the future up until retirement and beyond. Down here, you can see these 3 key points in time: now, entering retirement, and the end of projection, all with their projected net worth and the according age and year. The end of projection year can be adjusted up here in the control section, and you can choose it freely based on life expectancy or any other life milestone. In the control section, you can also select the output mode for the model values to be either nominal, which will show your net worth in actual future dollars, or inflation adjusted, which will show your future net worth in today's purchasing power and give you a more realistic view of what your money will actually be worth in the future. Down here, you have the custom net worth goals that we've previously defined in the net worth dashboard, along with the age and year you're projected to reach them. And by marking the show column, you can make these goals visible in a net worth projection chart above. The basic model is driven by the assumptions you enter over here, starting with the fundamentals like your initial annual net income and expenses, the income growth rate, and your personal inflation rate. These are the core inputs for the cash flow projection over here, which models your future income, expenses, and the resulting net cash flow, which is either positive and then used to buy assets and pay off liabilities, or it is negative, which effectively means you need to pull money from your assets to cover part of your expenses. Over here in the bottom of the fundamental section, we can adjust your assumed future asset gains and liability costs, which directly shifts where your projected net worth is headed. In the next section, we can modify the birthday, which will simply change the projected age numbers appearing down here. And we can also find out how changing the year of retirement impacts the model by, for example, setting it to 5 years earlier or even 10 years earlier. As you see, this has a significant impact on the model's trajectory. And that trajectory changes again when we assume your previous income from your job gets replaced with a stable annual retirement income, like for example $24,000, which grows at 3%. Over here in the cash flow projection, you see that the net cash flow after retirement is still negative. To cover this gap between income and expenses, the model automatically liquidates a portion of the assets in each of these years. For this, you can define how asset sales should be taxed on average, starting with the percentage of the sale that is taxable, the average effective tax rate, and an annual tax-free allowance. Keep in mind that the projection you are seeing right now is adjusted by inflation. At any point, you can switch to nominal mode, which shows the actual dollar amounts and naturally makes the growth look much more exponential. In inflation-adjusted mode, though, all future values are discounted by the personal inflation rate you set down here, giving you a realistic estimate of what those future amounts would be worth in today's purchasing power. So far, this projection only includes your projected base cash flows, which makes everything look smooth and linear. But that's not how life works. To make this projection far more realistic, I added the option to define extra cash flows down here. In this table, you can add an extra cash flow by defining a name, like your 401 contribution, selecting the type as either savings, income, or expenses, define an amount, then a start year where we're going to take the current year, the last year where we go for the last year before retirement, and a growth rate. To actually include this extra cash flow into the model, you then need to set an X in the include column. Extra savings like the 401k will directly impact the net worth projection, while extra income and expenses will indirectly impact the net worth projection by shifting the income and expense levels in a cash flow projection on the right first. Take a side hustle, for example, which is extra income, providing, let's say, an additional 15k net, starting in this year, and lasting not until retirement, but we plan to end this a few years earlier. Once we include that, we instantly see how the income level is increased for this defined time span and then drops back to the base level after the last year of the side hustle. Let's also add some extra expenses, and a great example here are children. They add additional costs on top of your base expenses, but only for a limited number of years, and the amount usually changes across different life phases. So let's say we include a first child in model. For the early years, we assume additional annual expenses of 15k, starting in 2028 and lasting a few years until 2032. After that comes the school phase, where the extra expenses increase slightly to 20k, starting right after the first phase ends and lasting all the way until 2044. And finally, we add an after-school phase where the child might go to college and require a bit more financial support. Before you wonder, I'm entering these initial amounts in present value, meaning the amount they would cost today. That's possible because the input mode for extra cash flows is set to present value in the controls section. In that mode, every future extra cash flow is automatically adjusted upward using your personal inflation rate, so you don't need to calculate what these expenses will be in 10, 20, or 30 years in nominal terms. You simply enter what they would cost today, and the model handles the inflation for you. But that's only for the initial year. The rate by which the amount grows after that is determined in the growth percentage column. And if you simply want to have it grow at inflation rate, you can set it to that same number of currently 3%. Now back to the after-school years of the first child. We assume these to last from 2045 to 2048, growing at inflation rate, and then include them into the model as well. Now that we have these extra expenses for the first child included, we perfectly see the expense projection going through these three phases before dropping to the base expense level again. And when we add the cash flows for a second child, born 2 years after the first one, the expense projection shows even more level shifts over the years. The net worth at the end of the projection is still positive though. Now let's add another extra cash flow to see how extra expenses in retirement, for example for traveling, hobbies and health, will impact the model. Let's assume an additional 20K starting in the retirement start year, which currently is selected as 2045, and then the last year equal to the selected end of projection year. As you see, including these additional expenses into the model causes the net worth projection to fall below zero before the end of projection, which tells us that this scenario isn't sustainable. So now it becomes interesting to see how adjusting certain assumptions, for example the retirement start year, can improve the outlook. However, before we change anything, let's quickly link some of the years defined for the extra cash flows to the other assumptions. We want the retirement extra expenses always dynamically start in the retirement start year. So instead of hard-coding it, we can just reference that value. And we can do the same for the last year of that extra cash flow by linking it to the selected end of projection year. In the same way, we can also make current cash flows like the 401k and the side hustle always dynamically start in the current year. And make the 401k contribution dynamically end in the year before the retirement starts. Now, when we change the retirement start year to be 2 years later, not only the base cash flows are updated, but also those dynamically linked extra cash flows. Retiring just 2 years later already has a major impact on your projection, and it improves even further if you increase your assumed annual asset gains by, let's say, 1%. And just like that, you can experiment with all kinds of assumptions and scenarios which will always automatically start from where you currently are. So as you track more months, the projection always recalculates from your latest data, evolving alongside your actual financial situation. The whole modeling is done transparently in this part of the worksheet, starting based off your latest tracked total asset and liability values, and then projecting year over year based on your assumptions, making the net worth projection the perfect bridge between your day-to-day tracking and your long-term financial planning. And that's it for this walkthrough of the Personal Finance Suite. Both the single pro templates and the all-in-one Personal Finance Suite are available on excelfind.com. Link for that is in the description. And I can tell you a massive amount of work went into these pro extensions and into making the suite run perfectly as one system. So I'm incredibly excited to hear your thoughts and feedback in the comments. And with that being said, I wish you a beautiful day and see you next time. Cheers!